Hello, Dr. Chen here. Today we're going to talk about Chapter 2. And again, Chapter 1 and Chapter 2, they're all introduction chapter. So for Chapter 2, we're going to talk about a lot of the terms, a lot of the concept. Okay, let's go. First, what rules are accountant required to follow? Of course, in the US, everybody knows that this one is GAAP, generally accepted accounting principle. And if you talk about international standard, which is adopted by pretty much all the country except US, and it is going to be IFRS. Okay, it's International Financial Reporting Standards, right? If you talk about the difference between GAAP and IFRS, let me give you a simple example. When we talk about GAAP is rule-based, based on rule-based. Okay, and when IFRS is principle-based. Okay, let me give you a simple example. If you know about the highway system in Germany, and what happened is in Germany there's no speed limit. Not like what we have right here. If you talk about I-30, and usually you see a speed limit 70 miles per hour or 75 miles per hour, right? But in Germany, if you talk about their highway system, there's no speed limit. And however, you need to follow a principle, which is drive safely, okay? And that's exactly what IFRS is doing, okay? It's principle-based, okay? And if you talk about GAAP, it's rule-based, just like I-30, right? You cannot drive over 70 miles per hour or 75 miles per hour, right? That's the basic difference, okay? And actually, in a little bit, we're going to talk about SEC is under a lot of pressure to adopt IFRS, right? We're going to talk about it in a little bit, okay? Now, let's take a look at the second one, okay? Who provide input into the various accounting rules, which authorities group determine the various accounting rules, right? And basically, it's the Financial Reporting Standards Board, okay, set the GAAP. And of course, all stakeholders can provide input to Financial Accounting Standards Board, okay? And we all, in Chapter 1, we talk about all the stakeholders. Right, accountants, investor unions, lenders, SEC, okay, pretty much everyone can provide input to Financial Accounting Standard Board. And we keep talking about SEC, and also I show you if you want to find out the financial statements, you need to go to sec.gov to look for the financial statement. SEC is an agency which can modify and set GAAP, and they don't usually they don't challenge FASB, okay, Financial Accounting Standard Board. All right, what are the various reports that a public company must file with the SEC? And the example are the following: 10K, we talk about that. I show you, and also I show you how to get the 10K. And 10Q, it's quarterly report, and you have 20F, and remember that 20F is only for the foreign company, and which went public in the US. And you have current report, you have policy report, and you have other SEC filing. For the 20F, I want to talk a little bit more about 20F. Before the 20F, before the requirements of 20F, this is what happened. If you're a foreign company, you went public in the US, you of course, because you're a foreign company using GAAP in your home country, then what happened is you need to prepare financial statement using IFRS, okay, International Financial Reporting Standard, and then SEC force you to prepare financial statement again using GAAP. All right, that means they need to prepare financial statement twice. All right, one time is under GAAP, one time is under IFRS. However, in the recent years, and SEC said, okay, fine. If you have already prepared financial statement using IFRS, then you just need to file a registration statement, and then which is 20F. Okay, you don't need to find financial statements under GAAP again, right? So basically, it's saving those companies a lot of money. They just need to prepare financial statement one time under IFRS, and then file a 20F, reconcile whatever you have in IFRS, okay, under IFRS. All right. Next one, what are the various environmental factors affect the reporting of various financial statements? Okay, first one is IFRS. Okay, and again, SEC under a lot of pressure to accept IFRS. Okay, and this one is set by International Accounting Standard Boards. It's not currently accepted in the U.S. Okay, and some of you folks may ask me why IFRS principle base is not like not using the rule base we have in the U.S. Right? The reason is very straightforward. Think about it, because pretty much all the other countries are using IFRS, and what happened is different country probably have different legal system, different enforcement, different culture, different way to do business. So it will be impossible to like ask everybody to follow one rule, right? And so what happened is you need to give a little bit freedoms to those countries to adapt IFRS, right? So that's why you just need to follow a single principle, okay, or several principles instead of like follow a specific rule to prepare financial statement. Okay, and next one will be the managers, okay, and of the companies, and their responsibility is to prepare a fair and accurate report, and they need to follow GAAP, and of course they can use managerial discretion to make estimate, okay, when they prepare financial statement. Remember the example we talked about in chapter 1. When you talk about bad debt expense, then of course it's up to the manager to estimate what percentage of your account receivable is going to be uncollectible. Okay, it could be 5%, 3%. Okay, it's totally up to the manager. Right, and next one, auditing. Okay, SEC require audit report. Okay, if you check the annual report, okay, just like the one I show you from SEC website, okay, and it always comes with the audit report. And auditor will put down their opinions in the audit report, and it's either clean or it's unqualified. Okay, and this is another name for clean report. We call it unqualified. Right, and that means your report is fine, it's fairly presented, or you have qualified report, meaning there's something wrong with the report. And the extreme version of the qualified report will be adverse report, meaning that it's possible that there's fraud happening in the company. And the last one will be disclaimer, meaning that the auditor don't have enough information to issue opinions on this company. All right, let me talk about recent change about the audit report. Okay, before 2017, auditing companies just need to put down the company's name. All right, but recently, I think is at the beginning of 2017, SEC asked all the auditing companies also put down the partner's name. All right, so more right now, if you talk about academic research on this one, people find out that if you ask them to put down the audit partner's name, audit firms is going to be more conservative, and the audit quality actually increase. All right, there's one thing I want to talk about related to the audit report. And we talk about this, the time of the audit qualifications, except for qualification, okay, which is like something is wrong, is qualify. And then a verse is going to be extreme version of the qualified report. And disclaimer mean that you don't have enough information to issue opinions. All right, next one is the corporate governance. Okay, and we have a board director oversee, okay, the corporate governance, and you have internal audit committee. Okay, right now we talk about the audit committee is the internal audit committee, and they oversee the accounting process, oversee the process of the prepare financial statements, okay, and also oversee the internal and external audit. Okay, now for the auditor report, we talk about the external auditor. This one, audit committee, we talk about internal auditor. Okay, and then next one, the environmental factor will be internal user. Okay, including everything, managers all the way to controllers. External user is going to be shareholders, okay, lenders, and all the way to customers. Right? And what are the various alternative sources of information that you can get for financial statement analysis? Okay, and you have other things such as economic, industry, and company news. Okay, voluntary disclosure. Okay, sometimes managers don't follow a timeline to report earnings announcements. What happened is probably they will do voluntary disclosure. Okay, one way to do it is probably is manager expectation. Okay, let me give you an example. Let's say based on the timeline, I need to as a company I need to report my quarterly financial statement at the end of this month. But I feel like that I don't have a good quarter. I don't want to surprise my investor or other shareholders or the market. Then what I will do is probably I report some bad news right now in order to manage the expectation and give them a little bit time to digest what is going on right here. Right? So you have voluntary disclosure. And also you have other sources such as analyst reports. Okay, what they if you talk about analyst report, what they have is they will collect and process, interpret, and all the information they have and issue a report. Okay, and usually you have analysts from the investment bank. They will follow industry and they follow a specific company, such as the high-tech company or pharmaceutical company. They will issue a report and tell you their views on the industry, on the specific company. Okay, you can also get related information from their report. Okay. And what are the key desirable attributes that analysts want to see in the financial statement being reviewed? And first one is going to be relevant. Okay, that means all the information need to be relevant to decision making. And second one, it need to be reliable. Right, all the information reported in the financial statement need to be reliable. Okay. And first, it need to be verifiable. Okay, if you say that you have like 1 million in inventory, it could be verified, and it need to be faithful, and it need to be unbiased. Okay. All right, talking about the limitation, and there's 3 types of limitation. The first one is going to be timeliness. We all know that. The reports we got is pretty much quarterly report or annual report, and we don't get information and on real time basis. And of course, if you invest in the stock market, we know that the market price change pretty much every second. However, if we don't get real-time information, then it's going to be really difficult for us to make decision. Second one is going to be the frequency, and this one is related back to timeliness, because we only get quarterly and annual report. We don't get the daily or monthly report, which just makes sense because it's going to cost the company a lot of money, a lot of resources to prepare daily or monthly report. The last one is going to be forward-looking. Okay, what happened? What is shown in the financial statement? It's already has already happened. Okay, it only provide information in the past. Okay, we got limited information for the future. All right, next one I'm going to talk about is actually the accounting concept. The first concepts I want to talk about is the historical cost. For the historical cost, one example I can give you folks is about the land. Okay, for example, Company A purchased a land 20 years ago, and it cost them $2 million. Okay, probably the land, the same piece of land, worth $20 million right now. If the company doesn't want to sell it, then what happened is, on their financial statements, on their balance sheet, they can only put down $2 million on their financial statements. Right? That means we need to follow historical cost accounting for that piece of land. And basically, for some items on the balance sheet, they need to follow fair value accounting. For some items on the balance sheet, they need to follow historical cost. In a little bit, I will talk about the difference between historical cost and fair value accounting. Second one is going to be the accrual accounting. We know that manager can use their own discretion for some account to make estimation. Example could be estimating debt expense, right? And another example could be estimate residual value of the equipment, of the buildings, of other long-term assets. All right, so that means a manager can use their own discretion to affect the final accounting number, and this is the accrual accounting. When you talk about accrual accounting, this is a short-term one, and this one related back to the example I gave you, account receivable, because account receivable is short-term asset, and so the estimation related to that, right? When you estimate uncollectible account receivable, then it's also going to be the short-term accrual, and the long-term will be again related to fixed asset, right? Since fixed asset usually is long-term, and when you make estimation about the useful life, residual value, then those going to be long-term accrual, right? All right. For this one, I will talk a little bit more about accrual in a little bit. Now, let's talk about the next one. And all the information need to be materials enough to affect decision making. Okay. And the last concept I want to talk about is conservatism. Okay. When you talk about conservatism, there's two types of conservatism. And actually nowadays a lot of academic research in accounting are focusing on conservatism. Okay, so when you talk about conservatism, two types of conservatism. One is unconditional conservatism. Example could be research and development expense. Based on GAAP, it doesn't matter how much money you spend, you have to expense all the related research and development expense right away. Okay, you cannot capitalize it. Okay, even though like for some pharmaceutical company or for some high-tech companies, they spend a lot of resources to come up with a patent. They cannot capitalize those expenses. They have to expense right away, right? it doesn't matter if you come up with a super cool pattern. It bring a lot of cash inflow in the future years. It doesn't matter. Based on GAAP, you have to expense all the research and development expenses right away. Second one is conditional conservatism. Okay, and as we all know that GAAP treat revenue or treat gain and losses differently. Right? For gain, you recognize gain when they are realized. However, for losses, okay, you have to recognize losses immediately. Right? So that's an example for conditional conservatism. Right. Another example for conditional conservatism is for fixed asset impairment. Okay, you have to recognize loss immediately. Okay. However, you don't actually recognize gain on appreciations of your fixed asset. Right. All right. Next one, we're going to talk about the fair value accountings and also the historical cost accounting. All right. For fair value accounting, usually on the balance sheet we report market price. Okay. Most likely we're gonna use fair value accountings for marketable security. All right. Example could be company A is buying shares of company B. Then on company A's balance sheet, the share price, the shares they have for company B is going to be reported based on market value. Okay, so if you talk about annual report, okay, on the last day of the fiscal years, then they can easily find the fair value, the market value of the shares of the company B. Then they report those numbers on this financial statement. All right, let's take a look at example from the book. This example talk about the difference between historical cost and fair value. Let's see. All right, first one, let me just make it bigger. The story is this. The company is buying a condo, and of course, if we just use historical cost, and the condo has depreciations every year, and at the same time, because you rent the condo out, and you're gonna have revenue based on the rental income, right? Let's see what happened. So let's just take a look at historical cost one. Okay, year one historical cost, year one closing, and historical cost of year two closing. And also we want to look at the historical cost income statement. Right, so pretty much we just focus on the columns on the left hand side, and let's see how it goes. And actually the historical cost one is the one we are familiar with. All right, so the condo cost is going to be 100,000, and to fund the purchase we have long-term debt, we have shareholders equity, meaning that 50% of the 100,000 comes from borrowing money from the bank or other financial institution, and the other 50% come from shareholders, right? Okay, this is the year one opening. At the end of year one, what happened is we have depreciation expense, okay? And then so that's why the condo cost, the condo value goes down. And also we have rental income, and the final income is going to be 8,500, and that's why shareholders equity is increased by 8,500, because the 85 we close the net income, it goes to retainings part of our shareholders equity. So we have the similar things in year two. Okay, and again the value goes down because we have depreciation expense, and also the shareholders equity increase, right? Because if I have income, right? So this is like the one we're familiar with, historical cost, and usually for the fixed asset we use historical cost. However, if you change everything based on fair value accounting, then let's see what happened. All right, condo 100,000, 50/50, okay, and this part is fine. However, the fair value goes up. Why? Because you have appreciation, right? Because like the value of the condo, the market value of the condo probably increase, and that's why you have unrealized gain, right? And that's why in year one it looks good, 36,000. However, in year two, the value goes down. The market probably the housing market is not that good, right? So it goes down, and you have negative income. Okay, so here it actually create a problem. Okay, first you have fluctuation income, right? Not like historical costs. You have pretty much have a very smooth income. Okay, even though you know that the income growth is very smooth. But this one, it jumped really high in the first year. However, if the market um, doesn't increase that much, or even like for this scenario it goes down, then you have negative. Okay, so you have income fluctuation. And also, if you take a look at the gain and loss, if you allow manager to do that, then what happens is probably manager can play their game, like they manage earnings by that. Okay, because first, condo, you don't have actually a completely active market on that. Okay, who set the price of the condo, right? You may argue that you can hire someone to appraise it, give you appraisal. However, probably if you ask different people, okay, they give you different price. So that's like it actually, if you just use fair value accounting for condo and actually give the manager more freedom to manipulate incomes, right? So this is the one I want to talk about. Next, what are the key concepts related to reporting earnings, reporting income? All right, accounting concept of income. Okay, pretty much is, and again, this one is based on accrual accounting, revenue recognition and expense matching. For revenue recognition, revenue need to be earned, right? Meaning that if you are selling products, meaning that you deliver your products to your client. And if you provide service, then meaning that you have already provided service to your client. At the same time, okay, in order to recognize the revenue, at the same time it must be earned. At the same time, it should be realized or realizable. Okay, let me tell you the difference. When you talk about realize, it means that you get the cash, right? Well, if you talk about realizable, meaning that you have the account receivable, you expect to get the money, right? Okay, this is like the how we recognize revenue. At the same time, expense we match. If you talk about product costs, meaning that if you're selling products, then it should be cost of goods sold. Okay, the product cost should go to cost of goods sold. Right? For the products, probably it's sitting in your inventory, you didn't sell it, then it should be it should be inventory, right? It should be part of your asset. So it should not be cost. Okay, for those products you haven't sell. But for the product you sell, you have revenue, then your cost should be matched with the revenue, right? So you have cost of goods sold or cost of revenue. Right? At the same time, you have period costs such as advertising and administrative expense, which is support the operation of your company. Okay, so this is like expense matching. Okay, all right. All right. We go back to one slide. I want to say one more things about accrual. Right, and again, this one, the two main process, we have revenue recognitions, we have expense matching, then because it's based on accrual accounting. And when you talk about accrual accounting, okay, it's pretty much your net income is equal to operating cash flow plus accrual. Let's see if I can find you an example right here. Right, I'm using the eBay balance sheet or financial statement. Let's see, financial statement. Statement of cash flow. All right. Um, if you're familiar with the cash flow statement, you know that actually you have the indirect method for the cash flow from operating activities. So pretty much we start from net income, and then um, we make adjustment of the accrual. Then we have the net cash from operating activities. Okay, so that's the reason why I want to show you this is it actually is this formula is talking about net income. You make adjustment of your cash flow, then you get your operating cash flow, right? That's exactly, and that's why we call the indirect method right here, right? You have net income, we make adjustment of the accrual, and you pretty much you see all this account is accrual. The example will be like depreciation and amortization, right? This is long-term accrual, right? And you have other things like account receivable, okay? Change of account receivable and another change of a current asset, okay? So you make all this adjustment, then you get the cash flow from operating activities, okay? All right. So this is actually this formula is talking about. All right, let's take a look at the example from book, and then we're going to talk about the difference between accrual and cash flow accounting. So the scenario is this: establish a company and invest $700 as equity, and then purchase plain T-shirts for $5 each, and of course they're paying cash. And you have fixed screen costs, you have variable print costs, and the company sell $10 each for cash, and the other 25 on credit. All right, if you take a look at the cash flow accounting, so basically what happened is all the cash inflow is going to be your revenue, all the cash outflow is going to be your payment, and finally you're going to use inflow minus outflow, you get the total income. Right, and since it's cash accounting, you don't need to worry about revenue recognition principle and expense matching principle, and you just find out your cash inflow and cash outflow. So even though, like first one, you need to take a look at it. Even though we sell 25 and totally we sell 50, however, only 25 we receive cash, $10 each, so we have 250. And T-shirt purchase, okay, since we pay all the cash at the beginning, so it's all outflow, 500. And the screen purchase is going to be $100. We pay all cash, and the printing charge is going to be 75 because we pay all cash. And finally, you have net cash outflows, going to be 425. So for the asset and liability, because we don't deal with that, so we only have cash and also equity. And since we have cash outflow, so it reduced our equity to 275 for the first year. All right, let's take a look at accrual accounting, and this one is actually we are more familiar with this one, and this one actually give us more information. Okay, so first one is revenue. We have $500 revenue, and T-shirt we have $500 revenue. Okay, and that means we include all the cash sales and the credit sales. And the T-shirt costs, instead of like 500, we only include we follow the matching principle, the expense matching principle. We only include the costs related to how many units you sell, because we sell only 50 units, so we only include the costs, the 50 units, the cost of the 50 units of 50 T-shirts, right? So the screen costs, we do not expense them all at the same time. We have depreciation, so 50 is this year and 50 next year. And printing charge also, we using the matching principle. It match with the 50 units sold. All right, so finally you have net income 162.50 cents. And if you take a look at the balance sheet, for those T-shirt we haven't sold yet, so we put it as inventory. And we have receivable 250. We expect to receive the 250 units. And for equity, you have beginning, you have ending. And final equity is going to be 862. So from here, you will find that actually accrual accounting made more sense. Because if you take a look at the cash accounting and the expense or the t-shirt, even though you haven't sold the other 50 units, they expense them all. So that's why you have a huge negative in the first year. And next year, of course, you have huge positive, right? And first, this one actually create fluctuation, right? Second one is if you talk about difference between cash flow and accrual accounting, this one actually create more stable income. Okay. All right. Now let's take a look at the accrual and cash flow myth and the truth. First one is, since the company value depends on future cash flow, only current cash flow are relevant for the valuation. And this one is incorrect. If you have the book review, you can take a look at the chart on page 87 and the chart on 88. You can find that actually net income is really important. It's more important than cash flow, right? When used to predict the future price or the stock price. All right, so that means net income is more important, and we know that income is the combined effect of cash flow and accrual. So you cannot say like only cash flow are relevant for valuation. Second one is all cash flow are value relevant, and this one is incorrect. Many type of cash flow do not affect company's value. Okay, for example, if you have the book, and again, you have the book review, go to page 89. This table, if you talk about the cash collections on credit sale, when you collect the cash, like you collect the cash for account receivable, it doesn't affect the value of the company. Right? Number 3, all accrual accounting adjustment are very irrelevant. And this one is also incorrect. Example, again, it's going to be page 89. It's a bit 2.7. This table, if you talk about the first one, sales on credit, it actually increased the income. Right? When you sell something on credit, increase the income. Even though it's adjustment on this is accrual, and it increased the income and also increased the value of the company. And number 4, myth number 4, cash flow cannot be manipulated. And this is incorrect. Example could be research and development expense or advertising expense. If manager want to manipulate the income upward, then what they will do is they will reduce the expense on research and development or advertising expense. In that way, they can manage the incomes upward. And those, we know that those are cash flow. Right? Myth number 5, all income is manipulated. Okay, I won't say it this way. I will say to some extent. Okay, and also academic research show a lot of evidence that manager or CFO, CEO, they have done earnings management and they manipulate the income, and also they have motivation to do this to manage incomes. However, I won't say all incomes is manipulated. I would say to some extent incomes is manipulated. Myth number 6, is it impossible to consistently measure incomes upward in the long run? And this one actually is not true. Okay, example could be what happened is manager have different ways to measure the incomes upward. And like for example, if they use accrual to measure incomes, you may find that like after a few years, right, there's no way to hide accrual. What happened is they will release the bad news at the same time, all at once, right? And however, they will wait for the bad year. Like for example, during the economic crisis, okay, investor understand, oh, everybody is performing really it is performing not really well. So they kind of expected that. What happened is they released all the bad news, all right, during that years, 2008, 2009, 2010, and then they will start to do earnings management to manage the incomes upward again, right? And this behavior, we actually got a name for it. We call it Big Bath theory, right? We call it Big Bath. So pretty much, they keep earnings management for years, and then they wait till the bad years and release all the bad news, release all the cool they cannot hide in that year, right? In that way, they will say the investor would understand, right? Because the year is not a good year, and all the other companies are not doing very well, and so they release that in that year. We call it Big Bath, right? And the truth is, accrual accounting is more relevant than cash flow. Or you can say income is more relevant than the cash flow. And as I asked you folks to look at the chart on page 87 and 88, we found that it's actually income is more relevant to predict the markets. And you have a stronger relationship between the stock price and the income. And cash flow are more reliable than accrual. That's true, because when you talk about accrual, it's based on estimation, okay? And of course, cash flow is the cash in hand. It's more reliable. And the accrual accounting number is subject to accounting distortion. And this one is true because manager can use this discretion to manipulate income because of the accrual. Company value can be determined by using accrual accounting numbers, right? And this one is actually also correct, because if you remember the formula we use in chapter 1, if you take a look at page 42, the formula we use, the residual income formula, then we find out that the value actually is calculated by using book value and residual income. All right, so company value can be determined by using accrual accounting numbers. All right, we talk about the reasons why we want to do accounting analysis. And we know that in chapter 1 we talk about what is accounting analysis. Basically, we look at the transaction, events, and accounts, and try to find out if those numbers are truly reflecting the reality of the company. Right? If we find out there's some distortion, then we make adjustment at the end. All right. So the demand for accounting analysis is adjust for accounting distortion. So better financial reports better reflect economic reality. And also adjust generally purpose financial statement to meet specific analysis objective or particular user. Right? We all know that if you talk about different user, even though we look at the same financial statement, we probably look at it using different angles, right? Investor, bank, and regulator, we look at it at different angles. So we need to make adjustment. Next one is the source of accounting distortion, okay? Because we talk about the reason why we want to do accounting analysis, because we want to make adjustment and we want to fix the accounting distortion. Of course, we are not going to be like 100% fixing the issues right here, but at least we can make it better. So the first one is going to be accounting standard. Right? We talk about distortion come from accounting standard, because we have GAAP, then we have conservatism, and we don't recognize, we don't treat revenues or we don't treat gains and loss uh, um, using the same way. And also you have like different accounting principle and assumption, and you have critical process of standard setting. Then we all need to take a look at all of this, and in order to fix, in order to adjust for the accounting distortion. Second one is estimation error. Okay, this one is different from earnings management. Okay? Earnings management is the manager doing it on purpose, right? This one is not on purpose. Okay, but however, you may have different view. If like manager made estimation on the bad debt expense, if you have different view on it, if you find out that one of the key client is actually in trouble, then probably you need to address it for it, right? And number 3 is reliability versus relevant. Okay, and attribute to overemphasis on reliability at the loss of relevant. So want to what happened is sometimes the financial statement may be overemphasized on reliability. Okay, and instead of like provide more relevant information to decision making. Last one, of course, is going to be earnings management. We actually talk about earnings management in academic research. We got 3 types of earnings management. Right? We got 3 types earnings management. The first one is related to accrual. Second one, talking about accrual, it's just like the accrual accounting topics we just talked about. When you talk about accrual, it's related to short terms, related to long term. Right? Manager actually get their discretion to make decision on the accrual part. Right? Second one is we call it real activities earnings management. Real activities earnings management. Example could be reduce research and development expense, reduce the advertising expense. In that way, they increase net income. And another example would be like just like in chapter 1, we talk about it. Companies overproduce a specific products on purpose. In that way, spread the same fixed cost into more units of products. So your unit product cost is going to be lower, and that's why your cost of goods sold is lower. All right, this is another example for real activities earning. Activities number 3 is actually, we call it classification shifting. Right, classification shifting. What does that mean? Is you shift some expenses. For example, okay, let's say some expenses should be administrative expenses, but you shift those expenses to maybe discontinue operation section. In that way, you try to hide expense, right, from the core earnings, and in that way, probably your operating income is higher, right? It's overstated, right? So you get this 3 types of earnings management method. Let's take a look at the next slide. An earnings management strategy. Okay, we can increase income. We can do a big bath. We record a huge write-off. And the last one is pretty much actually a lot of research is on an income smoothing. Right? It's arguably income smoothing actually to some extent actually benefit the company, because you reduce the fluctuation of the income. And so some research point out that income smoothing actually benefit the companies, and some claim that income smoothing is one type of earnings management. It doesn't reflect the real information to the public. So right now people, researchers still debating this one. All right, next one is gonna be the motivation. Okay, you have contracting motivation because you have compensation contract, and probably based on the contract, you have to make sure that your incomes increase by a certain percentage every year on average. And second one is you want to manipulate the stock price, because once you manipulate income, and then stock price will reflect whatever manipulations you have on the income. Another reason is because maybe the labor manager changes and you want to change the social views on the company. So what this slide is talking about is actually manager got all kind of motivation to manipulate income, to measure the incomes. All right, and this one is actually the last type of earnings management we just talked about, income shifting, right? Shift income from one period to another one, or you shift income from one section to another section, okay? And it actually affect analysis inference regarding the recurring nature of this item. And last one, this one actually talk about the steps: identify key accounting policy, evaluate extent of accounting flexibility, determine the reporting strategy. Okay, if you find out something and you need to identify and assess the red flag. Right. Let me give you a simple example on this, and actually later on we're going to talk a little bit more about this in the later chapter, in chapter 3 all the way to chapter 6. Let me give you an example, and this one is actually from eBay, and here I got the eBay's 10K from 2016. And what happened is, if you don't know about accounting analysis, and what happened is, if you take a look at the net incomes in 2016, you'll find that there's a huge jump from about 1 million something to all the way to 7 million. However, if you do know about accounting analysis, you find out that this one is actually not sustainable because it's related to the income tax expense, right? And you actually have a credit. So what I will do is, if I see this one, okay, because the core earnings, operating income, it does not change that much. So what I will do is, and however, the net income, you have a huge jump. So what I will do here is, I will just go open the 10K from 2016. And then we look for the income tax, and here on the notes they talk about the income tax, provide you the income tax information, and we find out that actually the numbers right here is not sustainable, meaning that next year you don't have a huge income tax credit. So when you try to calculate, when you try to look at the ratios, right, you need to make specific adjustment for that, right? If you don't know accounting analysis, what happens is you just go ahead and use the net income divided by, you're using net income divided by, let's say, total equity. You find out that, oh, this ratio, you actually got a huge jump, and that means 2016 is a good year for eBay, right? You cannot do that, because you find out that this part is not sustainable, right, after you do the accounting analysis. All right, next one I want to talk about is the analysis objective, okay, and we are going to talk about this in chapter 6, right? But here you need to know that you just need to know that we have comparative analysis, demand for financial comparisons between companies and between time. You have income measurement, and for the income measurement, demand for equity wealth change measure of the earnings powers. And then there's two alternative income concept. We have economic income, or we have accounting income. All right, last part of today's class, I'm going to talk about economic income, permanent income, and operating income. For operating income, we all know that what is operating income, and for permanent income, what this one is focusing on the sustainable profit. For economic income, it includes the cash flow plus the present value of expected future cash flow. All right. The reason why we get difference between accounting income and economic income is pretty much first one is income concept. Right? Income concept is so different, and then we have and that's the reason why you see two different concepts. And also, if you talk about the accounting standard we're using right now, some items we use economic income, some items we use the concept of accounting income. For example, if you talk about marketable security, and because we need to follow the market value of the security, then that means we use economic income. Because if we talk about market value, we consider the present value of the future cash flow. And second one is historical costs, and that's another reason we see a difference between accounting and economic income. Think about the example I gave you before. Company purchased the land 20 years ago. We spent at the time we spent $2 million. However, right now, if you talk about economic income, it probably worth $20 million right now. However, if you talk about historical costs, we have to recall $2 million on our balance sheet, right? If we use historical costs. And next one is going to be the transaction base. Okay, accounting incomes usually reflect the transaction. And also we have conservatism, right, related to accounting income, right, because of our standard, the accounting standard we're using. When we talk about accounting income, we need to pay attention to the conservatism. And also for accounting income, we have earnings management. We have this type of distortion, and that's why we need to do accounting analysis. All right, last one, I want to show you this chart. This one actually show you the relevance of accounting information. We find out that actually, except the bubble in 2000, normally accountings, and you talk about earnings, you have about 50%, right? It's about 50% range, sometimes higher, sometimes lower, right? And this one, the earnings actually, earnings combined with the book value actually explain about around 50% of the stock price. All right, that's all.